Today we're talking about risk. Specifically, we're talking about how we can minimize risk while maximizing reward when trading options. By now, you know me, you know my channel, and you know why I'm here. As a huge proponent of options trading, I've made it my mission to empower people like you to build wealth. But what about the risks? While I can't completely eliminate the risks associated with options trading, I can show you two specific strategies that can minimize your losses and keep your brokerage account moving in the right direction. Up. Let's get started. Thank you for watching this video. But before we begin, if you could, please take a minute to subscribe to my channel. And if you enjoy this, make sure you hit that like button. Also, if you know someone interested in options, please feel free to share this video with them. Now let's get started. Options trading presents unique opportunities for traders to amplify profits while, if done correctly, circumventing some of the biggest trading risks. But before we get too deep into the strategies I'll be explaining today, I want to remind you guys that all money making involves some form of risk. For instance, your day job, whether you're a bricklayer or an accountant, involves risk. Not as much as if you head to the casino with plans to bet on black 25 times in a row, of course. But the risk is still there. Like it or not, risk is ever present. So please don't expect this to be one of those videos promising to tell you how you can win at the stock market and retire in 2 years. That's not what I'm selling here. What I am doing is communicating specific, deliberate methods you can use to minimize what goes out and maximize what goes in. The first step, getting a better understanding of what options are all about. Options trading involves engaging in contracts that allow you to buy or sell an underlying asset at a predetermined price before a certain date. The most important thing you need to understand here is that while you can sell or buy the asset, you aren't required to. That's a very important distinction, and you'll see why shortly. You should also understand that trading options is not just one strategy, but dozens of smaller strategies. Because it is so multifaceted, you need to have a pretty nuanced understanding of how you can profit in specific situations. Think about it in terms of football. Even your sport-hating cousin knows you need to move the ball from one end of the field to the other. But that doesn't exactly qualify him to step onto the field and coach, does it? Real NFL coaches know hundreds of plays, study thousands of hours of tapes, and understand the game at a much deeper level. That's what makes them successful. So I don't want you to jump into options trading only knowing buy low, sell high. Instead, I want to equip you with the strategies you need to actively succeed. The two foundational instruments in options trading are call options and put options. A call option allows you to purchase a stock at a specific price, while a put option gives you the right to sell a stock at a predetermined price. Again, this is foundational stuff, and if you already know it, just bear with me for a bit longer. So you can employ these two basic moves across multiple strategies to speculate on the future price movements of an underlying asset or to hedge against potential losses in other investments. Meanwhile, the how, when, and how much determine where you sit on the risk-reward spectrum. Like I said in the intro, stock trading is characterized by a delicate balance of risk and reward. In my experience, and in the experience of many other traders, options trading is one of the best ways to find positivity in that balance. You also need to know that high-risk options often come with the allure of bigger profits. They also carry a greater likelihood of significant losses. Conversely, options with lower risk profiles tend to offer modest returns, but are far more sustainable in the long run. It's like the casino metaphor from before. The odds of winning betting on black 25 times in a row are astronomical, but not impossible. If it were to work, you could turn a $1 bet into $33,554,000 if you want. You can turn your options trading into a gamble, but you'll be more likely to lose big than if you take measured, controlled steps. That's the trade-off. Learn it, know it, respect it. Now let's talk about some tools you can use to your advantage. Among all the different strategies in options trading, two stand out as the most likely to maximize reward and minimize risk. They are selling covered calls and cash secured puts. These strategies involve generating profit through the sale of options contracts, but with different mechanisms for risk management. Let's look at them one by one. Selling covered calls involves owning a stock or other underlying asset and selling call options on the same stock. Remember, call options give the owner the right, but not the obligation, to buy the stock at a specified price before a certain date. The former is known as the strike price, while the latter is simply referred to as the expiration date. The term covered means that as a seller, you own the asset or stock. This is different from an uncovered or naked call where you don't own it. By selling the call options, you receive an option premium, which is essentially the income earned from providing that right to the buyer. Selling covered calls is considered low risk due to downside protection, limited obligation, and predefined risk. For instance, the premium from selling the call options can offset some of your losses if the stock price falls. Moreover, since you already own the stock, you don't face the potential for unlimited losses as with uncovered calls. Finally, the risk is limited to any additional gains in the stock price above the strike price. By selling the call option, you are simply foregoing any potential future profit. That's it. I found that this strategy can be particularly beneficial in a flat market. If the stock price fails to rise above the strike price, the call option expires worthless, allowing you to keep the premium and the stock. Cash secured puts are a strategy in which you sell put options while simultaneously setting aside enough cash to buy the stock if the option is exercised. Essentially, you're committing to buying the stock at a specific strike price if the buyer of the put option decides to sell it. The term cash secured implies that the seller of the put option has enough cash in their account to cover the stock purchase if the option is exercised. As with our last strategy, this differs from a naked put, where the seller does not have the full cash amount set aside. Just like with selling covered calls, the seller receives a premium for selling the put option. Essentially, this functions as an income earned for taking the potential obligation to buy the stock. Again, the risk here is simply any further reduction in the stock price once you own it. Additionally, by setting aside the cash, you guarantee you won't need to liquidate any other investments or assets to buy the stock if the option is exercised. Generally, this strategy can be profitable in flat or slightly bullish markets. Again, if the stock price stays above the strike price, the put option will expire worthless, allowing the seller to keep the premium. While selling covered calls and cash secured puts can be effective in reducing risk, they are not without their challenges. Remember, there's no such thing as a risk-free trading. Anyone who tells you that there is has an agenda. For instance, for covered calls, you already need to own the underlying stock, which can require significant initial investment. Additionally, there is the risk of losing potential gains if the stock price rises significantly beyond the call strike price. You also need to actively manage your positions, especially near the expiration date of the options. In the case of cash secured puts, you need to have sufficient cash reserves to purchase the underlying stock if the option is exercised. This can tie up capital that might be better used elsewhere. Furthermore, if the stock's price falls significantly, you may be obligated to buy the stock at the much higher than the current market value. As with selling covered calls, you need to actively monitor your accounts to make this work. Despite these challenges, selling covered calls and cash secured puts are popular strategies among many investors. In my experience, these strategies are often employed in popular ETFs like JEPI and JEPQ, but I also like to use them in my retirement accounts. In the end, the appeal of these strategies lies in their ability to balance risk management and income generation, making them a favored choice for investors with a conservative risk appetite. Remember that building wealth is all about minimizing that risk while doing your best to maximize the results. The stock market, generally, is one of the better ways to accomplish this, but that doesn't mean there aren't cowboy traders out there throwing caution to the wind in the hopes of a big payout. My point is that these people lose a heck of a lot more than they win, and you don't see the losses in their YouTube ads. In the end, what kind of trader you want to be is 100% up to you. Thanks for watching. If you have any questions or comments, please post them below. And be sure to subscribe and hit that like button. Good luck with your trading.